Senior Economist with the Federal Reserve, Steve Kennedy, Executive Vice President, Head of Energy and Energy Banking, Pedro Blanco, Managing Director at Intoro Capital, JP Hansen, Managing Director and Head of Oil and Gas at Houlihan Lokey, and Melinda Yi, Partner, M&A, Risk and Advisory at Deloitte. And so we can, start promptly for those who are not here. You can, obviously catch the recording. And so I will stop sharing my screen now, and I'll ask Jesse Thompson to, briefly introduce himself, and then he's going to go into an economic update from the Federal Reserve Bank of Dallas. Thank you.
Thank you very much, Mark. Jesse Thompson, as Mark said, with the Federal Reserve. Appreciate the opportunity to come and share the morning with y'all. I've been at the Fed for 11 years, and so it's been a very interesting 11 years to be at the Fed, and a very interesting 11 years to be monitoring and working in the energy space and in the hydrocarbon sector broadly. Before I get into sort of just my quick sort of overview, my energy update, I do want to say that my opinions are mine and mine alone, and not necessarily representative of the views of the Federal Reserve Board of Governors, bank presidents, officers, or anyone else associated with the Federal Reserve Bank in every way, shape, or form. And I just also want to give you all a little bit of a heads up here. So I am in blackout. And so some of the information in this is a little bit stale, but it's all very public knowledge. So no issues there. But if any questions come up in the Q&A about monetary policy, my answers will be either nothing or especially useless, even for an economist. So just that fair warning there. Now, to get through some of the meat of this update, one other thing real quick. I have a bit of an ask, and that is that we need your input. We have a number of surveys: the Manufacturing Outlook Survey, Service Sector Outlook Survey, which many financial professionals fall into, Retail Outlook Survey, and of course, as you'll see some slides later on from our Dallas Fed's Energy Survey. We survey Texas businesses all across the state. We try to keep our sample representative of the state as a whole, but getting feedback from real world business people making real decisions in real time has never been more important to the Fed than over the last 2 years. It's always been an important part, whether you're looking at the Beige Book or our surveys or other roundtables that the Fed does. That industry feedback, that industry commentary that we get from people who are actually making decisions, responding to market incentives, is very important piece of flesh that we can put on the scant skeleton of economic data that we have in real time. In real time, economic data, it comes with huge lags. It can be revised. Financial data leaves a lot to be desired in terms of understanding the economy in real time. And so getting that feedback is key, especially over the course of the pandemic, when so much has been happening so fast, with so many changes coming at businesses from literally every conceivable angle. So if you're interested in participating, there's a QR code at the end of this that you can use to link to us, to tell me, not only tell me how I did, but also sign up for our information and our surveys. Can't promise you get into the survey, but we definitely want to hear from you and hear what is going on out there, what you're seeing in your sector. We would appreciate you sharing your expertise. Just a quick sampling of that, and this is relevant for the discussion here. We asked about 300 different Texas companies, including energy supply chain companies, in our surveys, service sectors. When do you expect your supply chain to return to normal? We've asked it repeatedly the last year and a half. You can see things really changed from June to today, and the main thing to see here is that most companies in Texas have extended their expectation for when supply chains are going to normalize, to the point where the significant majority, say 10 to 12 months or more, or just say, I don't know. And bear in mind that this most recent survey example, which in my mind, over 10 months is the same thing as I don't know. If you look at the last survey we asked this question was February 2022. In April, we're going to get this one again. This was before Russia invaded Ukraine. This is before China lockdowns. And the massive buildup of ships over in Singapore. So this is, a massive buildup of ships over there in Shanghai ports. And so this has probably gotten worse. Bear in mind, now this is broadly speaking across Texas. The energy sector, oil and gas, was late to the supply chain and inflation party compared to many of the rest of us, because activity was relatively muted and spending in the sector was relatively muted for much of 2021, despite the sharp increase in oil prices, which I'll get to in a second. And so the oil and gas industry is absolutely seeing this in spades, such that the inflationary expectations within the oil and gas sector have now moved from, say, a year-over-year oil field service cost inflation of, maybe 10 to 15%, with the smaller companies being at the higher end of that in aggregate, mid-cap companies being at the higher end of that in aggregate, and the larger producers being at the low end of that range, to now universally, they're all telling me that that's actually a conservative estimate, and that we're probably pushing higher up into the teens for the industry in terms of industry cost inflation this year. What is the number one thing impeding hiring? Lack of available applicants. When you look historically across oil cycles, when do oil price spikes, not to alarm anyone, but oil price spikes typically happen, and busts tend to happen in conjunction with recessions. And when the oil sector is coming out of the doldrums, it's usually one of the first things to recover, because demand for oil and gas is very resilient to economic cycles. And so typically when they're coming out of a bust, their unemployment rate is relatively high. This is not the case right now. Unemployment is very, very low. You have sentiment issues in the oil and gas sector. And so we're hearing this in the oil and gas sector, but broadly across all companies: lack of available applicants, workers looking for more pay than offered. Very, very competitive place. This is something that we're hearing from the oil and gas sector. So these supply chain and labor constraints are a theme across the economy broadly, and they are most definitely being expressed vehemently in our feedback from the oil and gas sector as a constraint on their activities right now, and their ability to grow right now. Not just grow, I should say accelerate right now. Now, let me get into the sort of summary of some of the coming up data I'm going to show you. So I have to talk about Russia and invasion in Ukraine. This exacerbated an already tight global energy market. Global crude balances, so crude oil balances, are expected to tighten further, but the uncertainty here is very, very high. And if you look across analysts, you look across consultancies, banks, and their forecasts, there are parallel realities. There's a reality that says we get sanctions that stop Russia's exports, and there's a reality that says the commodities market finds a way, and the barrels, one way or another, heavily discounted, get out. And there's really nothing in between. So there's a lot of uncertainty built into what people are penciling in. Our supply response, for all the reasons cited, likely to be muted due to challenging labor market and capital discipline. And this tightening fuel market is driving up fuel prices and estimates for refiner margins. So refiners have a strong incentive where they are able to ramp up their consumption of crude oil as we head into the peak driving season. And remember, y'all, if history is a guide, and that's not saying that it is, if the history of the last 2 years is a guide, China lockdowns, that softening of global demand that's resulted from that is likely to reverse in the third quarter during peak demand season in the Northern Hemisphere. So the fundamentals for oil and gas sector look really good this year, and they look really good for next year in terms of actual physical supply and expected consumption, barring a stronger than expected slowdown in economic growth, which at this point at least doesn't seem to be in the forecasts, based off of what was published earlier this month at the Blue Chip Consensus economic forecasts for the global economy. And of course, now with all of this, exports are up, and this is kind of an undersold part of the story for what's happening in Russia, what's happening in Europe. So again, running through some of the high points, got to show you prices. A lot of stuff on here. This is the global energy crunch in one chart. The main takeaway for us here is that, number one, oil prices are very, very high. They're not nearly as high as natural gas and coal prices on an energy equivalent basis. And domestic natural gas prices are very low. And while now they're up higher than they were. This is the average for, this data is a little bit dated. This is average for a few weeks ago. Last week, the average was closer to $6-7 for the United States, but still huge delta. That spread between domestic gas and global gas is a huge component of a big arbitrage opportunity that's driving exports. And we're seeing record-breaking exports volumes from the Texas coast being driven in part by this delta, this huge cost advantage that we have, not just in energy exports and refined product and propane, ethane, ethylene, organic chemicals, inorganic chemicals, chlorine and caustic, the whole hydrocarbon downstream has a huge cost advantage here, and it's going to be driving an acceleration in exports, I think, because of what's happening in Europe. Now, so energy prices are off. So the big driver, the big spike that has happened here has, of course, related to the Russia invasion of Ukraine. This chart is the EIA's forecast. It is one of many. There's a lot. Do not take this as a given. Estimates vary right now, but we may be anywhere from 500,000 to nearly 1 million barrels below peak production from Russia earlier this year. The data is very hazy. We know that exports of crude oil have not really fallen. Russian crude oil exports have not declined in any appreciable way yet, based off of public data made available by tanker trackers, Bloomberg, and others, Vortexa. But we do know all that exports of product are down. And according to Russia's own statements, that decline in exports of product, the decline in Russian demand, and the decline in European demand has largely offset the decline in production. But that has caused a lot of refineries to see their storage capacity fill up. And as that storage capacity has filled up, you've seen refineries had to reduce run rates, and that is backing up all the way to the oil field. And that is what's driving, thus far, the decline in Russian output, crude oil production that we've seen. Anywhere from 1.5 to 3 million barrels per day. It's anybody's guess how much Russian production falls, how long this lasts. And then this last bullet point right here, I just want to point out to everybody, there's a lot being made of this $30 discount on Urals, this record discount that Russia is giving on its crude oil that it's selling. But I want to remind you, that's like over $70 a barrel. And it wasn't that long ago that the United States would have been, that the world would have been, oil producers would have been very happy with $70 a barrel. Now, averaging lots of different forecasters together, because an average of forecasts is generally less wrong than any individual forecasts over time, if you track it over time. And I'm being deliberate when I say less wrong, especially with the oil market. Right now, oil markets are tighten, 1.7 million barrels per day of consumption growth. The main takeaway I want you to, one of the main sort of updates I want to add to this little chart right here is you see a little bit of a decline in second quarter of demand. This is being driven in part by higher prices in Russia, but also the lockdowns in China. The main thing I want to note is that the Russian invasion and the lockdowns in China did not change the consensus endpoint. Meaning the consensus of forecast says that we end the year at the same level of consumption that we would have ended even without the Russian invasion or the lockdowns in China. So that this is telling us that demand is expected to be very inelastic to what's happening in oil markets right now. This may get updated to the next couple of weeks, next couple of months. As clarity emerges around Russia, we shall see. But there's just a lot of uncertainty around it. We've got a slightly tighter market. And so fundamentals, what a balanced market tells us is that the market is supporting oil prices, in a very constructive range for the E&P sector over the next 2 years, really. Now, the oil and gas employment, direct employment, is down to about 2008, 2007 levels in terms of where we are in total employment. In the state of Texas, if you look across the whole mining related sector, which you'll see in just a second, it's about that level. So in terms of employment boosts relative, after the shale booms and the shale boom and busts, and in terms of employment, we're back to where we were prior to the shale boom. And we're still producing nearly 11.5 million barrels a day of crude oil. When we look at in Texas, which Texas has over half the rigs, it's over half the jobs in the mining sector, broadly speaking, you look across the country. This chart kind of shows you in a nice fashion. I've got the rig count here in black. It's indexed to the price of oil. Here in 2016, when it bottomed out near $30. And this just kind of shows you the nice, fairly somewhat consistent relationship over time that you saw between the rig count and oil prices. And then, of course, this year, last year and a half, oil prices have skyrocketed. The rig count has been very, very muted. Now, there's a lot of reasons for that, which we can discuss more in detail in the chat. I think we've talked about it before. We had DUC count, we've had capital discipline, you've had labor and supply chain constraints, uncertainty about OPEC spare capacity, because OPEC was bringing a lot of production back online last year. We can talk more about that. The main thing for us here is looking at this curve, this orange curve. So if you look at across manufacturing, supply chain, oil field services, E&Ps, very muted growth, most of this growth being driven by fabricated metals and oil field services, really kind of accelerating here at the beginning of the year. Now, I'll remind you all that this data here for the beginning of the year is still subject to some revision, but it makes sense that we're seeing an acceleration because the DUC count is gone. If we don't accelerate rigs, regardless of how high energy prices are, if we don't accelerate rigs, we're not going to be able to continue to complete wells at the same pace that we did last year, which means we're going to see production fall. So this was a given going to happen anyways, which is kind of the theme for the outlook. An industry had planned to accelerate output this year, and because of capital discipline, because of supply chain and labor constraints, their ability to accelerate beyond what was already in the books is very limited. Now, there are some wildcatters, some smaller, private equity-backed producers who are going to challenge that a little bit, but we still think, if you average across projections, the United States is only going to grow production this year of crude oil by about 750,000 barrels a day, which is only slightly faster than we grew it last year, which feeds in perfectly with the story of measured capital disciplined growth over the course of 2021. 2023 is a different bet. We'll see what happens as investors enjoy the returns of these high oil prices this year. I just have to show this. This is break-even cost. So break-evens are operationally. This doesn't account for dividends or any of that other stuff. Operationally, break-evens for new wells are still at a very low level across various basins. And certainly when we ask them, hey, why aren't you accelerating production more at these exorbitant oil prices? They like to tell us investor pressure to maintain capital discipline, which, two sides of the same coin here, I have to say, two sides of the same coin, investor pressure to maintain capital discipline, inability to incur the kinds of costs that would be required to accelerate production beyond what the supply chain and labor force is currently capable of doing, is two sides of the same coin with investor capital discipline. So I think from an operations standpoint, I think it's very hard for them to do more anyways at any price, but certainly this is a big reason why. And we have many respondents telling us that it's really not dependent on price. And of course, I just have to show, I had this ready, so I have to throw out that export volumes of exports from the Houston Galveston Customs District, which includes Corpus Christi, Port of Houston, pretty much most of the Texas coast, except for Beaumont, Port Arthur. Record-setting volume of exports, and that volume is being, in terms of tonnage, that's being driven by crude oil. It's being driven by diesel exports, rising diesel and fuel exports, rising natural gas exports, and we can't forget rising propane. LPGs exports have really surged. So seeing really strong demand for the stuff that we're pulling up out of the ground in the global market coming out of here. So I'm going to stop there, and I'm going to move to just my closing here. Here's that QR code I promised you. And again, this will be in the recording, and this PDF of this will be available. I'll make sure it's available to Mark to share. And that is all. So thank you very much. I cede the floor, Mark.
Thank you so much, Jesse. I really appreciate that excellent update that you brought us from the Federal Reserve Bank. And folks, if you recall at the beginning, Jesse and the Fed, they do take industry, expert SMEs, subject matter experts. They do, want to take your information, and that helps him consolidate and produce these excellent reports. And so now we're going to go into the fireside portion of the conversation. Audience members, even though we're on Zoom, please, open your Zoom up. You've got 5 experts on the panel that are extremely difficult to get a hold of. Don't be shy, ask your questions. I will allow you to unmute yourself if you choose to do that, or you can put it in the chat and I can, go ahead and moderate for you. So, introducing Melinda Yi. She's partner oil and gas, mergers and acquisitions and transactional services at Deloitte. Melinda is a partner with Deloitte, and she leads Deloitte's oil and gas and M&A practice. Also, JP Hansen, Managing Director, Head of the Oil and Gas Group at Houlihan Lokey. During his career, Mr. Hansen has worked on numerous financing, M&A, A&D, valuation, financial recap, restructuring engagements. Also, Steve Kennedy, Executive Vice President and Head of Energy Banking at Amegy Bank. And finally, Pedro Blanco, Managing Partner at Toro Capital. And so we'll go right into our fireside session. And like I said, folks, please don't be shy. Ask your questions in the chat, or if you choose to unmute, you can go ahead and do so. So my first question will be to Melinda. So Melinda, ESG related investments of 1.7 trillion account for about 10% of worldwide fund assets across industries, but only 10% of oil and gas deals in 2021 cited ESG as their key deal rationale or openly communicated their ESG considerations in deals to stakeholders. So, for example, Bonanza Creek and Extraction Oil and Gas, for example, merged to form Civitas Resources, Colorado's first net zero oil and gas producer. Melinda, where do you see this trend going? Thank you.
So, I think ESG as a topic is only growing in terms of importance. It's certainly, on the minds of and discussed in most of the boardrooms today. Shareholders and activists are asking about it. And so, it's only growing in importance when it comes to a consideration for M&A and doing a transaction. Part of the challenge, though, is really how do you measure the impact of ESG? And there's various standards that are out there, and there's been some discussions coming out of COP26 as to how to converge those standards. The SEC recently came out and is promulgating some new disclosures related to greenhouse gas emissions for Scope 1 and Scope 2 that will essentially require filers to treat ESG data similar to how they treat financial data, with the same kind of controls over the integrity and consistency of that data. And the challenge there is really going to be, how do you manage that data? Because right now it's kind of found in different places. And so, that's a big shift for a lot of these companies, these public filers, in terms of needing to present that data and present it on a consistent basis. That's one of the things Deloitte did a survey of M&A executives, and for those in the energy and manufacturing sector, 59% of them noted that measurement was a key challenge. And so it's going to get a lot of focus. There's going to need to be some changes as part of that. And then the other thing I think with ESG is this discussion around energy transition, and energy transition's it's a common theme within our industry, and it's a common theme within M&A. And I think some of the events with Ukraine and whatnot are probably even accelerating some of that discussion and the need for this energy transition. And you're seeing some governments take action around trying to change even some of their net zero targets and acquiring them sooner, so that so they can then focus on energy security. So, and then another factor I think you're going to see that also contributes to this trend is the formation of ESG focused funds. And you're seeing, you mentioned 1.7 billion across industries in terms of investments being made. But I think there's also a whole class of funds being formed. And while previously these funds may have been thought of as more societal change type funds, and maybe the financial performance wasn't there, that isn't necessarily true today. And so you're only going to see demand for ESG focused investments increasing.
Thank you. And so JP, how is the ESG narrative impacting merger, acquisition, and divestiture transactions and the capital availability?
So far, with respect to transactions, particularly in the energy sectors, it has not specifically impacted M&A transaction activity, except in those sectors that are specifically alternative energy focused. And we like to think of to take back some of the narrative, because we all know that the world needs oil and gas. There is not a more abundant, powerful source of readily available energy globally than oil and gas. And so to call it energy transition is a complete fallacy. Long after any of our great grandkids are gone, oil and gas will still be around. It will still be part of the energy mix. So we like to think about it as energy expansion, because it's introducing other forms of energy into the global sphere. So how is it impacting M&A transactions? Honestly, until, as Melinda was mentioning, really the next stage, not only of reporting, but the implementation of, call it a carbon tax or some form of penalty depending on carbon footprint. There really won't be, as we see it, a driver within oil and gas M&A or an impediment to oil and gas M&A or a value differentiation. And there are value implications that are being discussed among M&A partners with respect to carbon footprint. But so far, where there are ESG activities, either on the plus or the minus side, those valuation differentials have not materialized in terms of M&A transactions themselves. Where we at Houlihan Lokey have been very active in energy expansion, renewable natural gas, for instance, LNG, carbon capture and storage, et cetera, where we have seen and been an active advisor in M&A transactions. Obviously, that is carrying the full weight of ESG, and that activity is largely driven by the ESG narrative, so to speak, and sought after by ESG-focused investors. But with respect specifically to oil and gas M&A, we have not yet seen the M&A transaction impacts due to specifically ESG.
Okay, thank you. I appreciate that, JP. So, Pedro, what are your thoughts with regard to the effects on inflation and commodity prices on M&A activity?
Yeah, good morning, everyone. Yeah, for sure. As any finance professional, both of those are variables that affect pricing, revenue streams, and cost. So for sure, both are inputs that you take into account when valuing and executing an M&A transaction. On the inflation side, for sure, people are getting a little bit worried of increasing cost for producing any material, or increasing costs for on labor and supplies. And on the commodity side, well, you can sometimes even have a different revenue projection depending on how we see those supply crunches and availability of the commodity affect prices. So for sure, both of them are taking a clear stage, or a first stage on whatever we're doing on the M&A side. Also, we're seeing a little bit of decline on the stock markets due to both variables. and that also reduced, the wealth that people have. And most of the transactions, when we do, for example, leverage transactions or transactions that are, executed with the help of big investment firms, if the wealth on their side is reduced, they will see a higher risk on deploying those assets. So for sure, many variables change when inflation change and when the commodity prices curves are modified because of expectations of supply and demand. Yeah.
Thank you, Pedro. And we have some questions from the audience that I'll begin to bring out. And folks, if you do want to ask your own question, feel free to unmute yourself. And we want this to be a free and open, like we said, fireside conversation. So, so we have a question here from, let's see, in the chat. Looks like I scrolled up way too far. Okay, so this is from Clint. Will we see any change in the current U.S. energy policies within the next year? And I'll throw that to Jesse first. Or what are your thoughts?
Will we see any change in the energy policies? It's hard to say at this point. Certainly there's now a sort of a strategic promise in place to be a marginal supplier of to supply more natural gas to Europe via LNG. In order to do that, you have to build more LNG plants, or you have to, and in order to do that, you either have to do something to accelerate the process of the ones that are already in the pipeline, because we were already building more, or you have to streamline the approval process for getting more LNG capacity into the pipeline, into the construction pipeline at our ports. And in many cases, this also means upgrading or changing rules around port operations. I mean, there's only so many port to call. Once you build that, when you build an LNG plant, you still can only bring in so many boats. There's only so many places that you can do this. And so that is going to involve, this is a big infrastructure build. And so that's, maybe going to be a reversal, I think, coming in that regard in terms of the Biden administration's willingness to do that. But it remains to be seen. There are other countervailing forces that are worried about the environmental impact of methane leakage and methane emissions and the entire supply chain for that. You worry about, there is an alphabet soup of regulators anytime you do anything near any body of water, let alone multiple bodies of water, which is what this is going to entail. And so it's a complex process, but bottom line, it's a multi-year process. And so even if the Biden administration does, sort of become more amenable to more energy exports from the United States, the fruits of any changes are going to be versus beyond what is already in the queue in terms of more export capacity. That is going to be something that largely comes to fruition beyond this term. That's going to be something that's like a 2024, 2025 in terms of major capacity, in terms of a major acceleration of new export capacity. Otherwise, it's hard to see that the Biden administration. I don't know what they're going to do on onshore or offshore, production. Thus far, it's hard to identify much of an impact thus far from the Biden administration on actual oil and gas production in the United States this year or next year. You're really the question is, if you look out to 2023, 2024, what happens in the Gulf of Mexico? That's really one area where the Biden administration could kind of change things around as a sort of medium term, 2023, 2025 in the Gulf of Mexico. But again, it's hard to say exactly, what impact they would have, because if I'm an offshore investor, do I want to spend more money in the Gulf of Mexico, or do I want to spend more money in Guyana and West Africa?
Interesting. Melinda, I see you making some facial expressions there. Do you have any comments on that question, or any of my other panelists?
No, I think Jesse summarized it well. I think there's a lot TBD in LNG with the constraints around infrastructure, constraints around the actual capacity and utilization of that capacity is a factor in terms of the exports for LNG.
Super, thank you. Okay, so this next question is to Steve, and Steve, feel free to join in and co-moderate. So what is happening with large secured RBLs, and can they fill out their bank groups, so reserve-based lending?
Thanks, Mark. Can you hear me okay?
I can hear you clearly, yes.
Right. Well, it's interesting because if there used to be maybe about 30 RBL banks that would do a secured RBL facility, there may be only about 15 of us left. And then there are another 10 or so that would join in if the deal is investment grade unsecured. But the group is again smaller if you're talking about secured RBL. And so recently we just saw a deal. I won't name the company because the deal's not done yet, but they wanted to increase their RBL to $1.5 billion, could not fill out the bank group to do it, tried to bring in a non-bank investor who would do a first lien last out. It would be kind of the first time that structure would be used in a healthy environment. I think it's been used maybe once before in a workout type of environment, but here it would be the first time that would be used to fill the void, the gap that banks are leaving in the first lien RBLs. And that was rejected by at least a few of the banks because it was just, I guess, too much brain damage to try to figure out legally whether they were okay with the first lien last out structure. And so they went back to the drawing board, thought about just leaving the borrowing base where it was, came back and decided to bring that same non-bank investor in for a second lien. That's being accepted by the banks because they've seen that before. It's actually not as good a structure because in bankruptcy, that's a separate creditor class. First lien lenders have been held hostage by second lien before and had to, allow them to take away some proceeds even when the banks are in a loss position. So in my opinion, it's not as good a solution as first lien last out, but that new concept did not prove to be accepted by all the banks. So they're going with a second lien, it looks like. So it's an more expensive structure. There is a problem with being able to fill out these first lien RBLs. So there's some groups out there that are working on unsecured loans, unsecured structures, sort of not institutional bonds. This would be for companies that are just below the level of being able to issue bonds to institutional investors. And they're working on putting together an unsecured structure that would work a little bit better for the RBL lenders and would fill this void. And so it's a big problem. We've seen companies like Apache who are unsecured be able to fill out a bank group even larger than the one I'm just talking about. So again, for the unsecured and in near investment grade or investment grade companies, we're not seeing that same problem. It really exists along the non-investment grade RBL secured facilities.
Very detailed answer. Thank you for that, Steve. And Michael Hines has a question. And Michael, I'm going to ask you, if you don't mind, if you want to unmute yourself, you can go ahead and ask the question to the panel. And Michael, are you available?
Yes, I'm here. And it's really a question for Jesse, if he can answer it. Your overall view of very limited increased US domestic production of about 0.7 million barrels a day in the second half of 22 going into 23. How does that square with the Biden's promise of increased US domestic production during this period?
Thank you, Michael.
It seems to be incompatible to me.
Well, thank you. So first, let me maybe clarify that 07, that was 750,000 barrels a day growth exit to exit in 2022. So that wasn't going forward. That was exit to exit in 2022. If you look to fourth quarter 2023, I don't necessarily even want to think about the uncertainty bands around that forecast yet, but I think we'll see continued growth. With regard to the Biden administration, how does that square with the Biden administration? Well, the Biden administration, to the best of my knowledge, has never drilled a well, and is never going to. The United States is dominated by private players operating on private lands, and not government-owned entities. There on federal lands there are, which is a small share of, I'm spacing right now on the actual share, but federal lands are a small share of the total shale oil production base, and a small share of the total oil production growth. It's the shale oil production growth that we've seen over the last decade. And there's leases and on existing leases and some new leases, there are permits available for drilling. The Biden administration can say whatever they want. It doesn't magically make the funding or the labor or the casing appear on our shores from South Korea. So, I would say that would be my explanation for why these two things do not square.
Excellent. Thank you, Jesse, and thank you for the question from the audience. And please, audience members, utilize the experts whilst you have them. This question from Rosalind Francis. Rosalind, do you mind unmuting yourself and asking your question to the panel, please? And if there's any other SMEs in the audience that want to take a chime at answering some of the questions, this is a no rules, obviously be polite, etc. We want this to be a conversation. So go ahead, Rosalind.
Hey, good morning. How are you, Mark?
I'm well. How are you, Rosalind?
I'm doing wonderful. Yes. Hi, everyone. My name is Dr. Francis. I have a new startup, global supplier. And my question is, how does a startup help with exporting goods and services?
Let's see. So I may be able to chime in on that. Rosalind, it's an energy startup, I'm assuming?
It is actually it is a construction startup. Okay. Construction. Mm-hmm.
Super. Yeah, have you heard of Greentown Labs in Houston? Where are you calling from?
I'm calling from Houston, Texas.
Okay, yeah, so that would be a great place to start. It's a very diverse organization. I believe it's ran by another female doctor from out of Boston. There's the Boston chapter, and there's also the Houston chapter. But the ION is also, which is across the street, which is also in Houston as well. It's a startup hub. You'll find many of the majors and super majors there, presenting from Chevron Technology Ventures to BP Ventures, et cetera, et cetera. So those two places are great seeding grounds for you to start. Also, Rice University, which is obviously Houston based, they have several startup competitions that they network founders with corporate VCs and corporates as well. I don't know if anyone else has anything to chime in on that.
Yeah, I have helped many startups, on many different areas. And for sure, Rosalind, what you need to do is reach out to whoever you think is gonna be a good partner. Initially, probably some of those partners that you think are the best partners, maybe you're looking for them, you find another partner that you're not even looking for, and that will help you, develop your business. Also, for sure, you have to offer well, something that is valuable for those companies and for the market and cost effective. So if you check all those boxes, for sure, you just have to go out there into the market and reach out to people using those organizations like Mark just mentioned to you. And with those, you will get in front of those partners that you need to, to grow your business. Yeah.
Okay, thank you. And Mark, I think you mentioned the ION, Rice University, and I think you mentioned one more. What was the next one, the last one you mentioned?
Greentown Labs, and if you give me a couple of moments, I will share the links in the chat. And also, actually, the Canon is also a good one. There's some really great startups. Data Gumbo has grown out of the Canon. It's an oil and gas blockchain. And there's a few other ones in there as well that are escaping my memory. But the Canon is also a great. There's tons of great resources locally that I know of personally. Los Angeles has the Los Angeles Clean Tech Incubator. We've done some events with them as well. So yeah, there's several incubators out there, and people are really wanting to help and form community, especially post-COVID as well. I think Greentown just had their year anniversary. So yeah, I'll share those for you shortly. So David Jackson, you have a question. David, if you don't mind unmuting yourself and posing a question to the panelists.
Yes, thank you. Just curious about the impact of electricity consumption for vehicles and how it affects the U.S. fuel consumption, or how it will in the future, what that time frame looks like. And then also curious about the fuel taxes that accompany vehicle fuel and how that gets replaced when electric power for automobiles takes over at some point.
And anyone from the panel, Melinda, would you like to take a stab at that? Or JP? We have a mute from Melinda. Jesse, what are your thoughts?
So let me just go with the first part of the question, because I didn't quite get the second part. First part of the question, what impact is it going to have? So if you look at, just take as a baseline, the calculations that were published earlier last year, because they're due for an update, but not much has changed. On the more, if Western governments in particular, but if global governments do everything that they have promised to do, not necessarily current law, but promised to do as of spring 2021 in terms of regulatory push and whatnot, then by the end, this is globally, by the end of 2030, by 2030, I should say, new vehicle sales, electric vehicles will reach nearly 30% of global new vehicle sales. At that point, that would mean that would have, so by the end of 2030, that would transition the global vehicle fleet to nearly 12%. There's some rounding error there, 12% electric vehicles. And if you do the math, what that means is that market share will go to electric vehicles. That shift in market share will diminish the demand growth for internal combustion engines, but there will be more internal combustion engines driving at the end of this decade globally than there are currently. And now those vehicles will also be more fuel efficient than the current fleet. Where there's a turnover happening here. If you buy an F-150 today, it's about, truck, it's about 30% more fuel efficient than that 10-year-old F-150 it's replacing, so to speak. So you are getting a fuel efficiency boost there, and you are seeing more vehicles on the road. There's still about 1 billion people joining the middle class over the next 20 years. What you will see, at least over that horizon, is less growth in demand for liquid fuel, but you'll still see the demand, but pretty resilient demand for liquid fuels over that time. X factor in that analysis is the work from home. How much staying power? What effect does work from home have in terms of demand for fuel over this time frame? Because that could erode demand growth over the coming decade, because you'll have a lot fewer people hypothetically sitting in traffic. Thus far, that's not in evidence, but that could happen. And if you're not parked on 610 or I-10 at least twice a day, that really does eat into Exxon's margins. So an Exxon sales. So longer term, that's that big question is really on the first half of that question, which is, there's going to be fuel demand through the end of the decade. For sure, even on a more aggressive path for electrification than we are currently on, assuming the supply chain can keep up with those government policies in terms of delivering the batteries and materials for that electrification. So a lot of assumptions there. No, I missed the second part of the question.
Thank you. Yeah, sounds like the electric impact is marginal on fuel supply. The second part is that, with fuel for cars come taxes that are included in the price of fuel for vehicles. And if electric were to, have an impact, then fuel taxes get reduced and fuel taxes are used for infrastructure repairs and such. And just curious about the impact. But I guess if the electric market is marginal over the next 8 or 10 years, the fuel tax side would really not be an impact.
Fuel tax has been problematic for years because it's a flat number that does not adjust for inflation, nor does it adjust for rising fuel efficiency in vehicles. And so there's a lot of different methods. So it needed to be reformed regardless of electrification. And it's been a growing problem. If you want your state to approve more taxes so that they can fill that hole, if you want your federal government to inflation and efficiency adjust the fuel tax, then you've got to tell them to do that. If you want fees to be added on to registrations, that's one of the most, I think, more popular solutions that state governments are talking about. So if you buy an electric vehicle, you've got a higher registration fee every year to sort of offset the lost revenue for funds allocated to the state. And of course, the old libertarian argument, you could just add more tolls.
Thank you. Yeah, more taxes.
I mean, we're underpaying right now. I mean, relative to our utilization. And if you want more multi-axle vehicles, you want more global trade. It's the multi-axle vehicles. Those are the ones that are tearing up the roads. So, that's another area. Do you want a user pays who's causing the damage, or do you want to spread that around as we all share in the economic benefits of that growth? Sorry, by all means.
No, that's good. I think the impact of the workforce being less mobile and more at home is a great insight. So thank you for those comments.
I'm a bit of a practical reality data nerd, self-confessed data nerd. To put all of those political regulatory targets are wonderful, but let's talk about the practical reality. In 2002, in the US, the average age of vehicle on the roads, this is passenger cars, this is trucks, this is every fuel consuming vehicle on the roads, the average age was 9.6 years. The average age exiting 2021 was 12.1 years. So the age of vehicles is going up. The more that income disparity becomes an unfortunate reality that we live in, the age of vehicles on the road will go up. The more that inflation that we're living through right now becomes a reality and the cost of replacing vehicles becomes a reality, the age of vehicles on the road will go up. So it's wonderful to put targets out there from a political standpoint on let's achieve what, electrification, new car sales, new vehicle sales, electrification targets by 2030. Those are wonderful targets to have out there. I can't wait to see how far we fall short on not only a US basis, but a global basis because of the practical realities of the world in which we live.
JP, thank you. And then I'll dovetail into another question for you. What do you think is driving current commodity price levels? And do you think the current environment will exist for relatively short or long term? And open that to the other panelists as well, JP.
Look, I think, and Jesse touched on some of this in his opening presentation. Ultimately, it comes down to supply demand. Demand is only going one way. Oil and gas and fossil fuel demand is only going one way. We're seeing a resurgence of coal usage in this current environment beyond what anybody expected. 3 years ago, even, there was an expectation that coal would have less than a 10-year life in the energy mix. And today we're utilizing more coal than we were 2-3 years ago, even 5 years ago. A lot of that is a replacement, of course, for what is happening in nat gas markets in Europe. But it speaks to the fact that demand is only going one way. Supply has been constrained even prior to the atrocities that are being perpetuated in Ukraine. There were two driving forces that were keeping a cap on supply on a global basis. Number one, the demand by stakeholders for a return of capital, as opposed to continuing to fuel exploration and development budgets. And number two is the ESG narrative, which had been diverting capital away from fossil fuels. And now that we find ourselves in an unfortunate global reality of needing fossil fuels, it's not like you can turn on the spigot at the drop of a hat. Jesse did a phenomenal job of explaining the practical realities, irrespective of what anybody's political agenda may be, the practical realities of actually executing an uptick in supply to meet that growing demand. And then all of that has been obviously exacerbated by the unfortunate situation in Ukraine and the ramifications across Europe.
Super.
And from my perspective, this is not, to answer your second question to that, we're not in a Goldilocks scenario. This is not a Goldilocks timeframe. This is going to be with us for an extended period of time, at least through 2023. I could see it extending into 2025, quite frankly, just because of those two market forces that were already trying to control supply, and combine that with the practical reality of being able to find, develop, and deliver hydrocarbons to a demanding marketplace.
Thank you, JP. And then Steve has a question, but Melinda, I wanted to see if you wanted to chime in on that from your point of view.
No, I think, JP summarized it well, and Jesse gave some overview comments around some of the constraints. And, we talk about the fundamentals and what's happening there. And certainly there is a disconnect between capital investment and oil prices. Historically, and Jesse mentioned this in his presentation, historically that's been very well linked. But certainly we've seen that disconnect occurring over the course of 2021. And in spite of the fact that oil prices have gone up, there just hasn't been that level of investment that folks have expected. And companies continue to be disciplined when it comes to their investments. And frankly, the capital markets are rewarding them for that.
Thank you, Melinda. And Steve, you have a question for the panel?
Yes, I have a question for the panel. So we've obviously seen some M&A, A&D transactions this year, but they've been somewhat muted compared to other times in history. And we're seeing the alternative monetization, which is to distribute cash flow to investors. That's become an increasingly used method to create returns. Do you think that we will reach a tipping point? Do you think we already have or will this year, where it will become more popular to sell assets or merge them at cash prices than it will be to distribute cash flow? I'm wondering if you think we will reach that point at some point this year. It seems like we're not quite there yet.
Melinda?
I think commodity prices being where they are and the events of the world happening, Ukraine, COVID flaring up in China, supply chain issues, it all creates this uncertainty, and folks don't like to transact in an uncertain environment. So I do think things are going to be muted for a good chunk of the year. There may be some opportunities out there, but my personal view is it's going to be muted.
Yeah, I would, it's a great question, Steve. I would actually suggest that the opposite has occurred and is starting to perpetuate. If you look in 2021, activity levels in M&A and D transactions were as high as we experienced in at least 8 years. You could argue as high and consistent as we had experienced in a decade. And we, once again, to my data nerd inner self, I required one of my lovely analysts to compute close rates for announced deals above 50 million in value, and what the close rate was of those deals. Here at Houlihan, we experienced 100% close rate. So I had to look more broadly besides outside of Houlihan, not to besmirch any of my competitors. But as an industry, there was approximately a 73% close rate in 2021 of M&A and D transactions. That's about 15 to 20% higher than historical norms. And that was driven largely because of a supportive commodity price, pent-up demand on the buy side, capital availability to support transaction activity from buyers, and an expectation that 75, 80, $85 oil and $4 gas was enough. I'm happy to transact at those levels. What we're seeing today is a bit of the reversion to the mean, and I expect that close rates this year will come down because, quite frankly, and we're in a number of these boardroom conversations as well, when you look at the keep case at $100 oil and $7 gas in the US, and you say, you know what, if the strip plays out anywhere near forecast, I can cash flow this out, I can repay debt in 2 to 3 years, and then I'm playing with house money. So that keep case is building more momentum than the sale case was in 2021. So I actually think while M&A and D activity is as strong in 2022 as we experienced in 21, I think the close rate will revert back to the mean. And so we'll see less actual closed transactions, even though there are more or equivalent launch transactions announced year to date.
Pedro, do you have any comments? And that was a great question, Steve, and excellent.
Yeah, for sure. And I agree with JP. What I'm seeing on the M&A, on the oil and gas, and this is, even anecdotal, what I'm seeing a lot on the transactions we're handling is people are not advertising anything related to oil and gas, but they are transacting. So even though it seems that, the transaction number is not there, it's because there is like a market perception that you're doing a wrong thing, but the market is there, the numbers are there, the demand is there, so people are transacting. So for sure, we will see with these commodity prices and with cash flow available, what we call dry powder, people will like to put the money somewhere where they can get the returns. So they're happening. The only thing is, I have this saying at the office that you just have to put your green jacket and then you transact. But the transaction is the same as 10 years ago. So yeah, for sure, I agree that we're gonna see some transaction happening because of the commodity and the demand situation. Yeah.
Those are great responses. And I wanted to say that we deal with a large number of private equity backed companies. And it may be that our view, in my bank is skewed a little bit by that fact. So thank you for letting us know that. That's interesting, and actually good to know that the market is healthier for A&D M&A than I originally thought.
And so what are you seeing in private equity space, in the energy private equity space, Steve?
Well, it seems like we're seeing more yield cos and smash cos and that sort of thing, but they are starting to transact. That's for sure. They're focused in many cases on distributions more than ever. And so, we as banks, RBL lenders have, put in restrictions on distributions. I think it's why you see so many companies operating under 2 times debt to EBITDA, because that's typically the requirement for distributions. The distribution requirement is typically set 1 turn below the debt to EBITDA covenant. So if the debt to EBITDA covenant's at 325, the distribution requirement would be below 225. And we're seeing more covenants set at 3 times debt to EBITDA these days. So generally need to be below 2 times to distribute. So it really is tough though, because when you can only employ about half of the debt capital that you used to, say 5 years ago, you're having to employ, a lot more equity, and that really hits returns. So that's part of the big problem with the whole market right now, is just low valuations drove, debt capital access lower, and debt to total cap lower. So that's where we're seeing transactions generally starting at 1.5 times debt to EBITDA and maybe something like 30 to 35% debt to cap. That's unbelievable to me. If I go back 5 years or 6 years, and if someone told me that 6 or 7 years ago, I wouldn't have believed it.
Very interesting. And any thoughts on that from any of the other panelists? Okay, so let's see. Rig counts are, and this was mentioned by Jesse, rig counts are well above where they were last year, but less than half of their pre-pandemic peak, which was less than half of the peak they reached before the 2014-15 downturn. What will it take to get more capital into the oil field, Melinda?
Yeah, so I think we've talked about this, and Jesse highlighted. We've mentioned just this disconnect between the decoupling of CapEx spend from oil prices, and we saw a 75% rebound in oil prices last year and record cash flows, as Steve mentioned, in 2021. But yet deal activity only increased. At least by the statistics that Deloitte's looking at, 18 to 31%, and CapEx only grew by only 17%. So I think it's right now there are a lot of constraints, not only because of just the fundamentals, but also and folks being rewarded for being disciplined and remaining lean and reducing emissions and focusing on those things, but also just the constraint of supply chain and labor. And Jesse mentioned that in terms of just not having enough applicants focused on the sector. And so, the labor market is a challenge across all industries right now. So that's a hard one to say when that's going to really change.
Okay, good. Thank you. I appreciate that. And so to JP, how do buyers think about developing and staging in context of mergers, acquisitions, and divestiture transactions?
Your question is developing and staging undeveloped acreage, or developing a merger and acquisition target?
targets?
Well, I mean, I think the strategy remains the same for any interested buyer. They're going to look at assets in basins, whether it's where they're currently operating or where there's a basin they would like to enter, and look at the economics, look at, you know, what contribution on a relative basis an acquisition would make to their existing asset portfolio, where the production and development of the target would fall within their economic ranking of their existing portfolio, or would a development prospect get accelerated on a relative basis in their rig line, so in their you know, development time frame. And so you look at it on a pros and cons basis in terms of the economic contribution, and think about it in the broader strategy. Those are conversations that occur irrespective of what's happening with commodity price. I would say that you know, there is a more supportive transaction and capital environment today for interested buyers to execute than there was even pre-pandemic, even, you know, the back half of 2019, where capital was starting to pull back from the sector.
Fantastic. And yeah, we have about 15 minutes, and so we'll be wrapping up shortly. And so I'm going to ask, you know, all of our panelists and folks, if you do have any questions, you know, speak now or forever hold your peace, that part. So what is your M&A and divestiture outlook for the rest of 2022? We could start with Pedro.
Yeah, well, I don't have like the full market information like the guys on the, you know, larger companies and the Federal Reserve. I will talk on my middle market transactions, and for sure we have a lineup of transactions going on. As I told you, and it's funny, but at some meetings people actually tell, please don't advertise it. You know, they don't want to know. People don't want to, you know, advertise that they're doing fossil fuel deals, but especially here in West Texas, we are seeing a lot of transactions on leases that are, you know, left to expire because of, you know, COVID, and companies doesn't have enough workforce. So we're seeing small companies coming in and buying up those leases and permits to be able to increase production and take advantage of the commodity price. So I think on the small market, maybe, you know, as JP mentioned, the 50 million plus market, I don't have all the information, but in the 50 minus, we are seeing a lot of small transactions. So yeah, I expect this year to be very busy on that regard.
Steve, what are your thoughts on with regards to M&A going forward for the rest of 2022?
Well, I think we've had, you know, a number of borrowers that have been working on paying down debt and making distributions. They're always looking for a good jumping off point, though. I think that, you know, we have funds that are reaching the end of their fund life. And so people are looking for the right window. And I think with the back end of the forward curve coming up, that, you know, especially for natural gas, we're going to be seeing a lot more transactions. So I would expect the A&D M&A to pick up substantially as the year goes forward. Oh, you're on mute.
Melinda, and what are your thoughts on the same question going forward for 2022?
Or so, you know, I think we've talked a lot about A&D, and I might just add from a broader energy perspective, I think you are going to see, you know, continued interest in activity from a renewables perspective. you talk about, there's a lot of developers out there that are, or a lot of interest, I should say, in acquiring developers. Maybe not as many developers for sale though, and that market is somewhat consolidated already, but still a lot of interest in that. So I think those that hadn't considered selling before are probably looking at that now. I think, there's some opportunities from offshore and offshore wind perspective. That's where some of the bigger players are interested in, because that requires a lot of capital. And then I think from a chemicals perspective, we haven't really talked about chemicals, but so much of that is here in the US. We really have the advantage from a chemicals perspective, given the natural gas prices in the US versus Europe and the rest of the world. So I think there's opportunity. That was a hot sector in 2021. And I think it's only going to continue to be active in 2022 as folks evaluate their portfolio and consider opportunities to divest, some of these larger players to divest, and to command some pretty high prices right now.
And JP, same question.
Well, I think my other panelists have described the environment very well. I think, and as I mentioned earlier, I think M&A and D activity will remain very robust. And I do think about it not only as A&D, but also corporate to corporate M&A activity. And I appreciate Melinda bringing in the petrochemical complexes and that sector, because I agree that I think that will remain an active space. I think downstream broadly in oil and gas will remain a hot space for M&A activity. We're seeing a pretty dramatic pickup, both on traditional oil and gas as well as energy expansion opportunities. As mentioned, we here at Houlihan have been very active in a number of LNG M&A transactions, as well as renewable natural gas on the downstream side.
Excellent. And same question to Jesse, or with regards to your overview of the rest of 2022.
Well, I think, certainly for the M&A environment, I would, the comments that have been made are fantastic. I'm taking notes, so I've actually having trouble keeping up. But, certainly, from a market from fundamentals to supply and demand, 2022 and 2023, it looks really good just on physical barrels availability and the relative inelasticity of demand. Thus far, the market looks really good. The outlook looks really good for supporting prices, for supporting healthy returns for the oil and gas sector over that time frame. Very uncertain, kind of beyond that, where we go, because we don't know what's going to happen with Russia or other issues. But I think that to the point that was made, that delta between domestic oil prices that Melinda was talking about. Delta between domestic energy prices and global energy prices, particularly European energy prices, is really driving a lot of arbitrage. And you're going to see a lot of companies trying to, particularly in the downstream processing space, looking to get more molecules that we pull out of the ground in the United States onto boats and into other countries. That pull isn't going to go away anytime soon. It was already there, and I think that this environment has accelerated it. And I share JP's skepticism on just exactly how this thing with Russia isn't going to go away anytime soon. This is a long-term issue. And so I think there's going to be a lot of opportunity for U.S. Oil and gas, both on the upstream, midstream, and downstream, to move more molecules into the global marketplace. And so I'm bullish in that respect. But near term, I think this capital discipline story or lack of capacity story, whichever one you prefer, is going to rule the day. It's easy to forget, in 2021, those fantastic returns that the oil and gas sector got were not simply a function of high oil prices, but they were a function of the fact that there was a deep inventory of uncompleted wells that they had spent the money on in the prior fiscal year. So it wasn't in the cost structure for 2021. They can't lean on that anymore. That's gone. That was gone, depending on whose data you like, as of January, February. And so that means you're going to have to drill more wells. And so just to keep production flat. So I think our capacity to grow is going to be limited this year. Next year, again, I think we're going to have some of the same story because it's still a tough sell, and what I'm hearing, and it's still a tough sell to say, I don't think anybody's going to rush in to say, let's build a whole new set of frac fleets. We got burn me thrice, shame on me. So I don't think that's going to rush. So I still think we're going to be constrained in that respect. You've got OPEC, not having any spare capacity in that respect. So again, the fundamentals are there for I think a strong market there where we're not going to destroy our own economics in 2023. Maybe in 2024, given the wildcatters enough time with high oil prices, they'll find a way. But I think the outlook is very, very good midterm.
Yeah, and just to add on to Jesse, your comments on DUCs and inventory overall, go to any operational engineer, go into boardrooms, pull up any research. There is a growing concern about the limited remaining tier 1 inventory in the US, which means that the further you fall into tier 2 and tier 3 inventory, the more expensive it's going to be to extract those hydrocarbons and get them to market, the more capital it's going to require, which means that prices are more likely going up, not down.
Okay, fantastic. And then, so yeah, we will conclude our function. I'm going to allow about 5 minutes or so. This is the FENG, Financial Executives Networking Group. So it's not really about us. It's about, like I said, deal flow, networking, and friendship. So if there's anyone in the audience that wants to kind of unmute themselves and just let us know who you are, 10 seconds or so, feel free to turn on your camera, turn on your mic. And just introduce yourself, tell us who you are and what you do, and so that we can do a little bit of networking. As we all know, networking in a Zoom function is quite difficult. So I see we've got Todd in the audience, Adele Hogan, Gary Brooks. He's the chapter lead for FEI, Financial Executives International. They have some really great programs as well as the FENG. We have a partnership with them. Gary, you want to unmute yourself and quickly say hello? Let's see who's asleep on the Zoom. Ha, ha, ha.
I can do that. Barely. Well, I was just napping a little bit. No, this great program, Mark. I enjoyed all your comments. You're saying some things that need to be said, I think. And if you're not familiar with FEI, come look us up, feihouston.org.
Wonderful. Thank you. And FEI has some great programs for financial executives and CFOs that they'll be hosting. I see Mike Aldridge in the audience. You want to unmute yourself and quickly introduce yourself, Mike?
Thank you, Mark. It is great to be here. It was a fantastic program. It's great to see Steve Kennedy and JP Hansen and some other folks that I know and hear them, and great insight. JP for grounding us back in reality. I appreciate that. And thank you, Mark, for doing such a great job of emceeing this event. Thank you. I'm VP Business Development with Mobius Risk Group. So we do commodity price risk advisory services.
Yeah, please share your information in the chat. And I see Barry Rava in the audience. Barry is a board member with SIPE, Society of Independent Professional Scientists. Barry, if you want to quickly unmute yourself and just introduce yourself.
Sure. Barry Rava. I'm not in the M&A game, but I like to stay informed. I look for places to drill wildcat wells largely, and listening to the talk about money, I agree with almost everything I've said. I've been telling relatives for a year now that the only reason things are getting done are the drilled uncompleted wells are getting completed, and we're running through that inventory, and then we're going to be up the creek without a paddle. Dollars wise per barrel in my mind.
Amazing. Thank you. As I see Adele Hogan in the audience. She's an excellent capital markets attorney up in New York. Adele, the former panelist, you want to unmute yourself and quickly say hello? What about Clint? You asked some really great questions there. Clint, you want to quickly unmute yourself? Looks like you're driving.
Yeah, absolutely. Thanks, Mark. Man, this is a great panel. I really appreciate all the insight. I really appreciate just the invite, man. This is fantastic. Great job for everybody. So I work locally with the Economic Alliance Houston Port Region. We do have a podcast called the Gulf Coast Growth Show. And so we bring on a lot of good guests that they just have a lot of great insight into what's happening here, mostly in the downstream space and with the Houston Ship Channel. So that's a lot of what we cover. There's a lot of the guests that we bring on. And yeah, man, this is fantastic. I appreciate the invite again. Thanks, Mark.
Superb. And then finally, Cod, and then we should be coming up to the 9 o'clock hour. And I do know that there are some busy professionals in our panel. And I just want to finally just thank all of our panelists and also thank the FENG Financial Executives Networking Group for providing us with this platform to share, engage, and educate. Cod.
Okay. Yeah, I appreciate it, Mark. Good job as always. Learned a lot of insight on this. Basically, I'm a consultant in the energy space, kind of green in it. Came from the banking sector for 20 years. So I do a lot of derivatives and options, things of that sort. And so listen to this and kind of the challenges in the oil and gas space. I kind of see where it's coming from. That capital discipline really speaks home to me. So I really understand that. So, but again, great discussion as always.
Wonderful. And I want to thank everyone for their time. Thank you for joining me for breakfast. 4/27/2022, the state of M&A in the energy industry. I want to thank Jesse Thompson, Melinda Yi, Steve Kennedy, Pedro Blanco, and JP Hansen, and then also the Financial Executives Networking Group. My name is Mark Hamza Arapogbo.